Welcome, everyone. I'm Kara Griffith, the President and CEO of Tax Analysts. Thank you for joining us today as we discuss cryptocurrency. The increasing popularity of cryptocurrency has prompted more attention at the federal and state level, and it's making it harder for investors and retail industry to comply with government rules. Today's event is the 16th in Tax Analysts series of public discussions that we call Taxing Issues. We launched this series almost 2 years ago as another of our efforts to encourage debate on tax issues. We've been bringing together the tax community with leading policymakers and experts for bipartisan discussions on the future of tax policy. While we hope and somewhat plan to hold in-person events sometime soon, for now we will continue to hold these discussions in a virtual format, and we welcome your feedback on how to make them more interactive. We also welcome your suggestions on future topics. You can send your feedback and suggestions to events@taxanalyst.org. We also welcome your questions for today's event. Thank you to those of you who email questions in advance. Please use the chat feature to submit questions during today's event. For our panel discussion, I'll begin by asking a few questions, and then I will turn to questions from you, our audience, and I promise to get to as many of them as time permits. And now on to the topic at hand. As many of you know, cryptocurrency is a form of digital virtual currency, and it's decentralized. In other words, it doesn't follow the guidelines of any centralized bank or government. Many people have been drawn to it as an excellent alternative to traditional investments, and it's seen as a great way to diversify a portfolio. The increased availability of retail funds holding cryptocurrency have expanded its reach into the portfolios of many small investors. Transactions involving cryptocurrency take place on a public ledger called a blockchain, which is designed to ensure that all transactions are fair and that they're free from what's called double spending. Double spending occurs when someone spends the same digital currency more than once. While the ledger is considered generally safe and secure, cryptocurrency also brings serious risks for investors, such as high volatility that can leave them with high returns, but also total losses. In the United States, for tax purposes, cryptocurrency is considered a capital asset, not currency. So cryptocurrency will be treated the same as stocks, bonds, and other assets that generally qualify for capital gains treatment. But it hasn't been quite that simple. The IRS may consider cryptocurrency a capital asset, and the cost of buying it would be the asset's basis. But people don't just buy cryptocurrency for its capital appreciation. They can also use it in ordinary transactions. For instance, a few online retailers now accept Bitcoin. However, when buyers use cryptocurrency in an ordinary transaction, they must also recognize taxable gain or loss on the asset. The failure to properly disclose cryptocurrency transactions is tax fraud, which can trigger civil and criminal penalties. And as I'm sure you know, the IRS is on the lookout for fraud. With the growth of cryptocurrency, the stakes are high for its users and for the economy, so compliance is essential. But so is appropriate federal and state regulation and guidance on reporting requirements and how the IRS will treat transactions for tax purposes. The 2021 Infrastructure Investment and Jobs Act changed reporting requirements for cryptocurrency, which signaled that regulators may be uncomfortable with the growing use of virtual currencies worldwide, but their use continues to grow. So what are the current reporting requirements? How will agencies distinguish between legitimate and illegitimate transactions? And how will the IRS encourage compliance and increase enforcement without creating an overly burdensome system? They're all good questions. And thankfully, we have the right panel to answer those questions. So first, we have Lisa Zarlenga. She's a partner with Steptoe & Johnson. Next, we have Carolyn Schenk, National Fraud Counsel with the IRS Fraud Enforcement Program. Also from the IRS, we have Mike Fiore, Area Counsel with the Small Business and Self-Employed Division of the IRS Office of Chief Counsel. And we have Abe Sutherland, founder and director of the Saker Group and professor at the University of Virginia School of Law. And finally, we have Lauren Slatkin, Vice President of Tax with Coinbase. Thank you all so much for joining us today. We are thrilled to have such a distinguished panel. Now, at the outset, I want to note that there are certain topics on which the IRS can't yet talk, and there are some procedural issues involving some litigation that Abe is precluded from talking about. Now, we're not going to shy away from those topics, but we may rely on our other panelists to provide some insight. I'm genuinely looking forward to our conversation today. I think it will be incredibly informative. So first, Lisa, to kick it off for us, I did a very high level background, but could you provide a little bit more background and sort of set the stage for us on the tax treatment of cryptocurrency?
Sure. Thanks, Karen. Thanks for having me today. It's great to be here. So as you mentioned, cryptocurrency is treated as property for tax purposes. And so this was part of the guidance in 2014, Notice 2014-21. And so it basically means that general tax principles that apply to property transactions apply to transactions using virtual currency. And so maybe more to some of the topics that we're going to discuss today, what does that mean for purposes of various reporting requirements? Well, if you would otherwise have to report a payment that's made in property, you would also have to report a payment that's made in virtual currency. For example, the value of virtual currency that's used to pay wages to an employee must be reported on Form W-2. Or if you're paying it to an independent contractor, it would be reported on a Form 1099 NEC. Other payments of fixed, determinable annual or periodical income that is made in virtual currency in the course of a trade or business and exceeds $600 would be reportable on Form 1099 MISC or miscellaneous. In addition, third-party settlement organizations are required to report payments for transactions that are settled in virtual currency on the Form 1099-K if they meet the threshold for that form, which of course was lowered after 10/31/2021 or 12/31/2021, sorry, to $600 to match the 1099 miscellaneous. Now, all of those forms were mentioned in the earlier guidance. And so it was fairly clear that those forms in some, if virtual currency were used in a transaction, would have to be used to report those transactions. What wasn't mentioned was whether cryptocurrency exchanges were required to file a Form 1099-B, which is the form that you typically get from your broker that reports securities transactions. So there was a lot of uncertainty regarding what the exchanges should be reporting. And of course, the practices by the exchanges as to which, if any of these forms were filed, has not been consistent over the past couple of years. So Congress stepped in, and as you mentioned, the Infrastructure Investment and Jobs Act, I just refer to it as the Infrastructure Act, became law in November of 2021. It amended Section 6045 to expand broker reporting to apply to digital assets. The definition of broker was expanded to cover any person who, for consideration, is responsible for regularly providing any service effectuating transfers of digital assets on behalf of another person. And we'll probably get into this later, but there is some question as to how ancillary that service can be. And the definition of digital assets is quite broad and covers any digital representation of value which is recorded on a cryptographically secured distributed ledger, or any similar technology as specified by the Secretary. So it gives a pretty broad grant of authority to Treasury and the IRS to add to that definition, also to exclude from that definition. And this certainly seems broad enough to encompass virtual currency as Bitcoin and Ether, but also stable coins and NFTs and other forms of digital assets. The legislation also treats digital assets as covered securities, which basically means that they're also subject to basis and holding period reporting on the 1099-B. The Infrastructure Act also amended Section 6045 Cap A, which is the provision that applies to transfers of covered securities by brokers. And it requires two things. First, if a broker transfers digital assets to another broker, then the transferor has to furnish the transferee with a written statement reporting various information, such as the basis and holding period of the digital asset, so that that transferee broker can continue to report that information to customers. Second, the legislation adds a new requirement to require information reporting for digital assets that are transferred from a broker to a non-broker account. So if a customer transfers digital assets from an account with a centralized exchange to an unhosted wallet, for example, that provision would require the exchange to report that. Now, these new reporting requirements are effective in 2024 for transactions occurring in 2023. So customers of exchanges will start seeing these 1099-Bs in 2024, but the exchanges are going to have their systems in place to start collecting this information in 2023. Back to you, Kara.
Bear in mind that is like it's a very short time frame from now. So
very short. And the government has not yet issued regulations implementing this. They're working actively on it, but they have not, the proposed regulations have not been. So we need to go through the proposed regulations, notice and comment, and then a final regulation before the companies know how to implement it.
That is an incredibly short timeline and a lot to get through. So Carolyn, let's turn it over to you. I know everybody is very interested in hearing about enforcement and how the IRS is handling things, how they have handled things and maybe how they will in the future.
Great, thank you. Thanks everyone for having the IRS here on the panel today. Also special thanks to everyone in the audience who's attending. I know that there's a lot of folks out there that are tax return preparers, accountants, attorneys, other advisors. Our system does not function without voluntary compliance, and you all play a huge role in that. So thanks in advance for all that you are doing, especially during the light of our current pandemic and some of the other stuff going on in the world, to get your clients, colleagues, friends, and family into compliance in all areas, including those involving digital assets. So let's talk a little bit about enforcement and the digital asset ecosystem at the IRS. From a Title 31 perspective, the IRS has a robust enforcement and compliance effort underway as it has delegated authority from FinCEN. Accurate and timely filings made under the Bank Secrecy Act are crucial for law enforcement and civil regulators. Examples of such BSA filings include suspicious activity reports, currency transaction reports, as well as registration of money service businesses, which would be required of exchanges in this community. One thing I do want to make you aware of is that the SBSE Bank Secrecy Act program has created a new letter. It's number 1052-A, informing digital asset exchangers and administrators of their potential BSA reporting and record keeping requirements. So that's something that the BSA program will be rolling out in some of their examinations. Now, from a Title 26 perspective, noncompliance in the ecosystem ranges from civil to criminal matters, both including and apart from tax evasion. However, tax evasion is often a component of other areas of noncompliance, particularly when criminality is involved. Both criminal and civil noncompliance often attempt to use digital assets to hide transactions, and that criminal activity often triggers a taxable event. Now, similar tools and techniques are used to trace digital asset transactions, whether those be legal or illegal. So that's basically the ecosystem that the IRS is operating in. Now, let's talk a little bit about what's happening in the field with respect to enforcement. In short, we have cases in every stage of the pipeline, from letter treatment to examination to appeals to criminal referral to active criminal prosecution. As far as letter treatment streams, in July of 2019, as well as in 2020, the IRS sent letters to more than 10,000 taxpayers who have engaged in digital asset transactions, but possibly failed to report those and pay tax on those. These letters were intended to help taxpayers fully understand to meet their obligations, and the IRS may continue to use those in the future. Now, if you or a client happens to get one of those letters, I highly recommend that you do not ignore it. You are now on notice that the IRS knows about your digital assets. As far as examination, we have taxpayers and exchanges under active examination in both a Title 26 as well as a Title 31 context. Now, taxpayers with unreported digital assets can expect the IRS to take steps that it wouldn't in any other audit, including interview, request for information, possibly issuing summonses, requiring interviews of the taxpayer's spouse, any beneficial owner. Also issuing summonses to other third-party record keepers, such as exchanges, banks, recipients, counterparties, other related transactions, or other related parties. So the question of whether a taxpayer engages in digital asset transactions is being built into every examination and every collection matter. As far as our criminal investigation division, there are digital asset cases in CI field offices located across the country. There have been a handful of public announcements as of late with respect to IRS and DOJ, Department of Justice activity in this area. CI is also using a data-driven approach to find and investigate financial crimes. And speaking of the Department of Justice, just a little comment here. We have a very collaborative relationship with the department as we work through these cases. We are focusing on defining tax evasion in this space. We are considering evidence, jury appeal, what a one-year tax case look like. We've also dealt with a number of other ancillary issues, including whether or not there's a right to privacy that can be invoked to prevent a taxpayer from producing these records to the government. We've been successful with all of those challenges to date. We have cases in active tax court litigation, both with the IRS handling those, as well as with the Department of Justice in civil suits, whether it be a refund or summons enforcement. As far as training, we have a phenomenally collaborative environment where all business units from civil to criminal are engaged in data integration as well as data digestion. IRS has acquired leading edge tools to de-anonymize transactions, to unmask parties and identify counterparty interrelationships, and also to locate assets, both digital and physical. We feel that data integration is really a key strategy to connect the dots between tax filings, bank transactions, phone records, internet posts, and just overall presence. It's also important to leverage all available data for really a maximum analytical impact. And really the key in this area is fluency. And so we are working very hard to build up that fluency among all areas of the IRS, from boots on the ground all the way up the chain. Now, Kara mentioned fraud. I think she said we are on the lookout for fraud. That is definitely correct. In my capacity as National Fraud Counsel, I work closely with the Office of Fraud Enforcement in implementing a national fraud strategy. Eradicating tax evasion with the use of digital assets is a key focus of the office. And so you'll definitely see more in the area from the Office of Fraud Enforcement with that. And lastly, let's talk a little bit about John Doe summonses. The IRS to date has done 3 John Doe summons actions in search of taxpayers who have unreported digital assets. For those of you who are unfamiliar, a John Doe summons is a request for information to a third-party record keeper for an unknown class of taxpayers. It's called a John Doe in essence because we know of the abusive activity, we just don't know who's doing it. In December of 2016, we served a John Doe summons on Coinbase, and we sought information from Coinbase with respect to all users who conducted cryptocurrency transactions on the platform between 2013 through 2015. And Coinbase ultimately produced documents for approximately 13,000 customers. Now, in March and April of 2021, we served 2 additional John Doe summonses to Kraken and Circle. And the IRS is seeking information about US taxpayers who conducted at least the equivalent of 20,000 in transaction in cryptocurrency during the years 2016 through 2020. Expect more from the IRS with respect to John Doe summonses in this area. So that, Kara, is kind of a little bit of a snapshot of what we're doing and kind of where we're going and all things kind of IRS from an enforcement standpoint. So let me turn it back to you.
Thank you. So to follow that, let's turn to Mike for a moment to talk about some of the current IRS guidance with respect to cryptocurrency, maybe some of the FAQs and the guidance that's out there to hopefully keep taxpayers and practitioners away from having to go down the enforcement route.
Thank you, Kara. Thanks for the invitation as well. I'm going to quickly go over IRS guidance that's out there now and what it covers. The first IRS guidance regarding the treatment of virtual currencies came in 2014 by way of notice 2014-21, which Lisa referred to. That notice states that for federal tax purposes, virtual currency is treated as property, not money, and that general tax principles applicable to property transactions apply to transactions using virtual currency. A common example of these principles in practice is if you use virtual currency to pay for your latte, you have taxable gain if the price of that latte exceeds your adjusted basis in the virtual currency. And the coffee shop owner would include in income the fair market value of the virtual currency on the date sold. And if you really love that latte so much and decided to get a job at the coffee shop as a barista and were paid in virtual currency, you'd have wage income subject to withholding as an employee. And that would be subject to information reporting under the rules. And just one quickly step further, if the coffee shop owner would also have capital gain or loss because he paid for your service using virtual currency and would calculate that gain or loss as the difference between the fair market value of the services received and the owner's adjusted basis in the virtual currency paid. Now we can go on and on using the general tax principles applicable to property transactions for other scenarios, but the IRS has issued a list of what is now 46 frequently asked questions that specifically cover my example scenarios, other scenarios, and much more. However, I will note some non-taxable events, which include purchasing virtual currency using cash, transferring virtual currency between all wallets you own, and receiving virtual currency as a bona fide gift. Again, these are covered in the FAQs. And for those FAQs and the other guidance that I'm mentioning, visit irs.gov and use search word virtual currencies. The IRS has also issued Revenue Ruling 2019-24 to address the tax treatment of virtual currency hard forks. That revenue ruling says that if you receive new virtual currency following a hard fork, you'll have income in the year the new cryptocurrencies actually are constructively received. Additionally, Chief Counsel has issued advice on several specific transactions, and one related to hard forks. Chief Counsel concluded that a taxpayer who received Bitcoin from the Bitcoin hard fork on August 1st, 2017, had an accession to wealth and received taxable income in amount of the fair market value of the Bitcoin cash at the time of attaining dominion and control. Another concluded that a taxpayer who receives virtual currency in exchange for performing a microtask through a crowdsourcing platform has received consideration in exchange for performing a service, and the virtual currency received is taxable as ordinary income. And then finally, the most recent CCA Chief Counsel concluded that transactions prior to January 1st, 2018, in exchange of Bitcoin for Ether, Bitcoin for Litecoin, or Ether for Litecoin does not qualify as a like-kind exchange under Section 2031. The IRS anticipates issuing additional legal guidance in the digital asset area. I'd specifically note that the 2021-2022 Priority Guidance Plan has 2 items related to virtual currency, one concerning general guidance about virtual currency and the other addressing the virtual currency information reporting regs under Section 6045. But until that further guidance is issued, taxpayers should take positions that are reasonable and consistent. So I know that was a lot in a short period of time, but I'll turn it back over to you.
Thank you. So I think that between Mike, Lisa, and Carolyn, we have a nice background now for kind of moving into some other issues in our discussion. Lawrence, can I turn to you though? Now that we've kind of have that background set for what the rules currently are, what are the challenges to compliance at the moment? What have you seen in terms of the reporting requirements for cryptocurrency, and how difficult is it to be in compliance?
Thank you for having me. I really appreciate that. It's great to be here. I was hoping Mike would tell us a little bit more about the date the regulations will be issued. He was on a roll with coffee, which is something I'm passionate about. So I was like really excited about that. From a compliance perspective, I want to treat this in terms of the average Coinbase user, because Carolyn referred to another side of this, which is criminal enforcement, criminal investigations. We don't generally serve that purpose. We have an entire team, in fact, of security personnel, people who actively cooperate with the law enforcement about finding bad actors in the system. And that's really not what we're talking about. We're talking about general compliance. I think of that, and I think Coinbase generally thinks about that in 2 ways. We think about it in terms of education and infrastructure. So, and our starting point really is that despite all the recitations we have about guidance, this is a relatively new, rapidly evolving area. There was actually very little guidance out there other than what I think Lisa first alluded to, which is that cryptocurrency or crypto assets are generally treated as property. Even the definitions we have that were first posited are actually different. So the IRS uses the term virtual currency, which has more of a financial security type parameter and set of principles, which would be governed by 6045 and other provisions we talked about. The new terminology that's being used in the Infrastructure Act is something a little bit more expansive. It's a little bit different. It's called a digital asset. And those are not entirely the same. So the way you look at it would be a little bit different. So I think when you have all that, you have essentially an open system where we're talking about basic principles. You have really a dearth of knowledge. And remember, we have a range of users on our system and in Coinbase who range from major institutional clients who are sophisticated, who are engaging in rather sophisticated financial products that include crypto, because this universe has expanded into their realm, and retail users who buy Bitcoin, who may be also doing what Mike just said, buying a latte with Bitcoin itself. So we have a whole range, gamut of people. So what is our role in a nutshell? I think education, we spend a lot of time. We have a tax center now at Coinbase, which includes a lot of learning, educational materials, how this should be treated, what the underlying principles are, how you should be thinking about it, with a focus on compliance, so that the underlying assumption is that our users want to be compliant. They may not be sophisticated enough to know how to be compliant, but they should know what the underlying principles are and how we should be thinking about it. We are also very much focused on infrastructure. So we are also building systems. So our underlying assumption has been, and really from the moment I started at Coinbase, the underlying assumption is that we should be treated on a parity with the rest of financial services. Nothing worse, nothing better. But in essence, if it is a financial product, and we can go into how certain new assets are not financial products, so they don't really fit this paradigm. But on the underlying assumption that Bitcoin, that virtual currency is governed similarly to the way other financial assets are treated, we're building the infrastructure to report and effectively crystallize the 1099 forms that Lisa alluded to. So there has not been clarity about how those apply in our system today, but we're trying to build that infrastructure and we're working very hard at doing that. We're also working very hard at giving our customers gain loss information so they can attribute, at least on our system, what their basis is and how to calculate gain or loss and all the parameters of income that I think we've all been talking about, which again, for the average user is not all that, they don't live and breathe this every day. It's not something that is necessarily coincident with the way they think about it and the way they trade. So again, education infrastructure is sort of core to me at least and core to Coinbase in terms of how we approach compliance.
If I could just make one comment, Kara, with respect to something that Lawrence said, I think you hit upon something really, really key, which is that, it's not necessarily that people that engage in this activity are bad actors, but the issue from a tax compliance perspective is that that's in essence tax evasion. The money starts off good, but then it ends up turning bad because of the lack of reporting on the return. So that's kind of where the government is coming from with respect to how normal people who are engaging in this activity are not then reporting it. That's where the problem arises.
Well, it seems that's why education is so important too, because you've got, let's call them regular people who don't necessarily understand all the nuances. It's a challenging space for sure. Abe, can we turn to you for a second and maybe talk to us and look prospectively? We had talked about 6050I and maybe going into a little bit of background on that and the amendment that was made under the infrastructure bill and sort of some of the consequences as you see them.
Sure. So this brings us to another element of the infrastructure bill. Lisa spoke to the amendment to tax code 6045 and the well-known consideration of the so-called broker provisions. And this is a completely separate amendment to that bill, which did not get particular attention either initially from members of Congress, nor really from the public for some period of time. Now, thankfully, that has changed, but that did go that was passed into law on November 15th. And while we do have some time before it goes into effect, also at the beginning of 2024, hopefully there'll be increased attention to this. And I'll come back to this, but there have been some developments there, including two initiatives from Congress, two bills introduced that would repeal this amendment to 6050I, which is a measure that I do support, and replace it with one of them would replace it with a study to be performed by the Treasury Department to really look deeper into what I believe are some overlooked consequences of this bill. So 6050I is a 1984 statute governing the use of physical cash, and it says that receipts of cash that don't involve a banking institution, because they're subject to other reporting requirements, must be followed with an immediate report by that recipient. In many cases, with amounts with the threshold being $10,000. Involving filing a form within 15 days, and that's Form 8300 if people want to look it up to understand what's involved under 6050I. So 6050I, as passed in 1984, is a particular kind of statute. It's geared to govern and based on a premise of a certain kind of transaction, which is a transaction made in person between two people on American soil, which is very important when we reach the complicated issues of jurisdiction that will be faced with enforcement of this, involving physical cash, whereas of course digital assets are quite a different type of instrument. So this requirement, just a few more remarks on it, it's important to realize and see the extent to which it's not really a tax reporting provision. It is in the tax code, but frankly, if this were passed today, it would not have been passed as a part of the Internal Revenue Code. It would be part of the Bank Secrecy Act. And if we have time or if there's questions, go there. I can explain how it interplays with some provisions in the Bank Secrecy Act, But this was passed as part of the Internal Revenue Code. And of course, the motivating concerns for tax evasion and so on are related to the broader picture of anti-money laundering. It's also unique in that violations can be a felony. That's distinctive for tax code reporting requirements. And it's important to note that this does not have a hook related to income, as most of these reporting requirements do. This is not about basis or income or anything like that. The statute applies to receipts, regardless of the tax consequences, and regardless even to kind of ownership or title to the funds at stake. So it's important to see how this was intended, again, with cash, and then looking ahead to what will be the effect with digital assets, really to discourage a particular technology. And that technology was physical cash, which even in 1984 was not particularly widespread or convenient for large, meaningful economic transactions, and to encourage the use of financial institutions, which of course are a much better fit for almost all of us, and to make sure, to provide those incentives for large transactions to pass through the banks and later the financial institutions, which are subject to the other reporting requirements, largely under the Bank Secrecy Act, as opposed to the Internal Revenue Code, that allows for the type of monitoring and surveillance needed to address these tax evasion, money laundering, and even counterterrorism concerns. But it's important to point that out because to notice the dissimilarities between the technology at issue here. Cash is a particular technology, but one that is I would even say largely obsolete for large economic purposes. But the point behind digital assets is that perhaps, just perhaps, it is not something that is perhaps something that can provide economies of scale and convenience and use cases beyond what is available through this legacy financial institution, which this statute will encourage the use of, because the amount of record keeping and compliance that will be involved in reporting these transactions, these receipts under 6050I as applied to digital assets will really change the nature of a digital asset transaction. And it's important also to mention here that the effect of this is I think, broader than many first think. And it's easy to see why perhaps this mistake is made in that, there's this thought that this provision treats digital assets with a parity to cash, right? Something that already applies to cash should apply to digital assets. But the key point here is that the uses of cash are already so limited as a practical matter, requiring physical possession and two people meeting in the same place. The appropriate comparison involves realizing that digital assets are really not just a substitute for cash. In fact, not at all. Digital assets are potentially a substitute for other technologies, and technologies specifically that we associate today with banking and financial institutions. And so the point there is that the effects of this extending 6050I to apply to digital assets are much broader and more sweeping than is immediately evident by just saying, oh, we're going to treat digital assets and cash the same. Digital assets will not be used the same as cash, and therefore the consequences here are much greater. One point that I think is really important is we're in this period with the law being passed and before it goes into effect. A common refrain to the treatment of this is that, well, we'll wait to see what happens in regulations. To a certain extent, that's often the case with Bank Secrecy Act regulations and other financial regulations, but that's not the way this statute works. The Section 6050I establishes the reporting requirement as a matter of the statutory text. The exemptions and potential exceptions that the Treasury Department may grant are established in the statutory text. So there's a lot less leeway than I think might be assumed with the matter of this complexity in the statute. So I think I'll leave it at that. But as mentioned, there has been increased attention to this, including on Capitol Hill. One of these bills has been a bipartisan effort, and it's got more than a dozen co-sponsors at this point. Something else I didn't have the time to get into or some of the privacy and constitutional concerns with a requirement for this type of reporting. But this imposition on persons' privacy rights is certainly something that will be challenged in court.
I think it's important to note in what Abe said that there's so much to talk about in this area. So Abe refers to an element of cash reporting, bank secrecy, which is a little bit totally dissimilar to what we were talking about earlier. It's almost like we're playing whack-a-mole with tax policy and crypto. So there are offshoots and evolutionary aspects that we haven't really even touched on. The blockchain can be used for a variety of different things. What is done on Coinbase is just one element of that. And we don't really have a tax policy, I think a coherent tax policy that addresses many of these points. So we're kind of like just in the dark trying to figure out how to do this. And so when you see what Abe refers to, which is you enact something, you think you've solved a problem, you want to open up a Pandora's box to other issues that have not been adequately considered.
I think that's a really good point. And it does seem like there's just so much going on right now that it's difficult to keep track of it all. I want to pose a question to the whole group. So we had a JCT report that came out that estimated that the amount of information, we increase the amount of information that the IRS is receiving on investors' profits and losses, we could see an additional $28 billion in new tax revenue over 10 years. So I want to open it up to the group and for two questions. One, is that $28 billion a reasonable estimate? And two, how's information reporting going to work? We assume the IRS is already receiving a lot of information. Would they receive more information? What would they do with that information? And then an audience question that came in is, does the IRS have the resources available to it to process additional information should it come in? So I open that up to the group for a conversation on both of the issues of whether the 28 billion is reasonable, is that a little too much? And then to get into kind of how some information reporting might work.
Yeah. With regard to 6050I, that 28 billion figure is especially frustrating because that report lumped in 6050I, 6045, and 6045A and showed no work on this. And 6050I is, again, it is not a regular reporting statute. In fact, it's part of a quite expensive criminal enforcement program, and it remains quite mysterious how anybody might have drawn a conclusion, and then to see those figures further lumped in with the other provision gives very little to go on to criticize that math, but it's certainly very suspect.
I would also point out that on the 6045 side of things, the IRS and Treasury already had the authority under the prior version of the statute to extend broker reporting to digital assets, because the prior definition of broker included any person who acted as a middleman with respect to property, which seems to encompass, at least the government's definition of virtual currency. And so I sort of wondered at first where this $28 billion figure came from. I understand by way of background that some of the thinking that went into it was that by adding certainty to the fact that IRS and Treasury could extend broker reporting to brokers of digital assets, it would take away any worry about their authority. So if a taxpayer would come in and challenge it, that would delay for potentially, years, the implementation of the reporting regime. And so I think by taking this out and making it more clear, the thinking behind the score was that, that would actually save money for the government. But I agree with Abe in terms of, I don't think they really thought about how broad 6050 Cap I could really apply in this context.
So anyone who is in the trenches in the infrastructure bill would probably tell you that no one knows how Joint Committee came up with the 28 billion. So I don't think we ever got clarity about that and what that was designed to include. Abe and Lisa said that very eloquently. I think the underlying assumption, though, was, to supplement what Lisa said, is that the infrastructure to create parity for crypto assets and the rest of financial assets to introduce a 1099B type format so that there's reporting with the underlying assumption, as Carolyn said, that people report what is ultimately given to the government, that increases voluntary compliance. That's sort of the underlying premise of all this. The 60/45 Cap A element, which exists today in the financial services industry, when you exchange, you move stock from or a security from one institution to another, would also exist within crypto. So we'd have that. There was an expansion moving crypto off crypto. So all of that is sort of designed to encourage voluntary compliance. And I think that must have gone into that number. How that number was derived, I don't really know. And we're also just scratching at the surface of really what was part and parcel of that. Look, I think Coinbase, Kraken, I think largely we talk a lot. I don't think anyone really questioned as Lisa said, I think we were sort of prepared for this. So it's not like this is anything new. I think what is really concerning is that we are 9 months away from an enforcement mechanism, and we really don't have adequate guidance, and taxpayers don't have adequate guidance. So we're kind of frustrated in terms of how we're going to do that. And I think as a result, we'll probably end up being, frankly, years away from an adequate just an enforcement mechanism, and the industry will continually move on and develop new products which are not even governed by this, which we haven't really even talked about.
So Carolyn, we've got the new boxes in Form 14457. Is that going to be sufficient to increase the amount of voluntary compliance that we're getting from taxpayers? Are taxpayers struggling with the form? Can you share anything on that?
Sure, I'd love to. So Kara, I think you're referring to the voluntary disclosure practice. Just to kind of back up a little bit and give a little bit of a foundation. The voluntary disclosure practice is really a longstanding practice within IRS CI, criminal investigation, for those taxpayers with criminal tax exposure to come clean, cooperate, and resolve their issues. This is not for a taxpayer who is merely negligent, forgetful. This is for a taxpayer with criminal tax exposure, which could be a path that some of your clients or you yourself, or depending on your situation and your nexus to your clients, you could have made the decision that they could be subject to a 7201 or 7206 criminal charge, or maybe they're part of a larger enterprise, so they've got some criminal tax exposure. So if that's the case, you can come into the IRS's voluntary disclosure practice. Now, as Kara suggested, Form 14457 is a required form that needs to be filed with IRS CI. It really comes in two parts. There's part 1 and part 2. And as a practice tip, make sure you're always using the most current version. About 2 weeks ago, we just released a revised version of the Form 14457 that does have an expanded section on virtual currency. So make sure you're using the right form. There's part 1 and part 2. Part 1, this is the part of the form that is for pre-clearance. It's basically a determination made by criminal investigation based on the information submitted by the taxpayer on the form and then checked by CI that the application meets the timeliness and other basic requirements. Once CI determines the application is timely, it's numbered, the taxpayer is notified, and then the taxpayer must then submit part 2 and sign it under penalty of perjury. Once received, CI takes the whole package, sends it out to a civil compliance unit in Austin for distribution, and then it goes through a normal civil examination. So that's a little bit of a background. Now getting to your specific question, yes, we did just issue a revised Form 14457 to include an expanded section regarding virtual currency. It is at question 13. It does ask for some basic information about the asset, including dates purchased, dates disposed, the type, that sort of thing. Then in the second part, after pre-clearance, is where the taxpayer would really walk through the specific details of the tax non-compliance. And again, we're only looking at assets that were non-compliant. So I think it is going to hopefully continue to increase voluntary compliance. The voluntary disclosure practice has been a very successful part of the IRS for decades, and thousands of taxpayers have gone through it and resolved their issues without much issue. The other thing too is that when a taxpayer comes into the voluntary disclosure practice, the IRS does have the expectation that not only is the taxpayer going to cooperate, but also that they are going to come clean, and ultimately that we're going to reach an agreement at the end of the process, which is really I think that's really how it's working now. So I do think that it's going to help taxpayers come into compliance. The other thing too is, earlier when I was talking a little bit about kind of what's on the horizon in terms of the IRS and what we're doing, we're very active in this area from a civil perspective as well as from a criminal perspective. So, and I know it is filing season. So if you have unreported assets or you have assets that you are planning on not to report, you might want to think really long and hard about that. As Lisa did suggest in the beginning, the IRS is receiving some information reporting already from certain exchanges, and we have been actively reviewing that information. So, you don't want to be in a situation where you're not turning in a tax return reporting, the very assets that the government may already know about. It's just not going to be a good situation. So I would get those assets on the return and get them on definitely in this filing season. And if not, then the way that you can come into compliance is either through voluntary disclosure or by filing an amended return. So.
Well, thank you. So for our last 14 minutes or so, I'm sorry,
before we go on, I was just gonna say, I would just note from the practitioner perspective, I think that practitioners generally appreciate the fact that there's now, that virtual currency is part of the voluntary disclosure program, and now there's specific questions to respond to that. I will say there is some confusion about how to respond to the question about whether the virtual currency is domestic or offshore. Given that there's, unless you have a hard wallet that you have in your physical possession, it exists on the blockchain, and it's hard to figure out where that's located. And there's also some, some concern about the time, amount of time it takes for that pre-clearance process. But I suspect that that's just due to IRS resources generally. And then to add to Carolyn's point about reporting it on your return, I would just flag that there's still this question on the front of the 1040 for people to respond to. It's a yes, no checkbox as to, whether, at any time did you, I think, receive, sell, exchange, or otherwise dispose of any financial interest in virtual currency. And the instructions now require that you actually check yes or no. And so if you have, it was identified earlier that certain things, like if you transfer virtual currency from one wallet that you hold to another wallet that you hold, or that you just purchase it and hold it, that's not, you can check no, but otherwise you pretty much have to check yes if you received virtual currency other than as a gift, or if you transferred it or anything like that. So just to be aware of that question on the tax form in terms of compliance.
To Lisa's last point, that's exactly right. There needs to be a checkbox, either yes or no. So that question has to be answered. And Lisa, thanks for your comments about the timing. I think you're exactly right in terms of the VDP process. It is taking longer due to our, we have some significant resource issues. I know people are probably tired of the IRS saying that, but I mean, that's true. The other thing too is I just want to point out that the voluntary disclosure practice application process has evolved in that we have revised the form twice now because we are hearing and responding to practitioners in the community. So as you start to bring clients through using this revised form and you have problems with the language or the boxes or the way the questions are being asked, or you're having a hard time navigating a situation, send me an email, send the VDP email. I mean, we look at those, we take those into consideration, and that's really how we've evolved the form. And I'm looking down because I literally printed it out. Probably thinking who prints anything out these days, but anyway, so it's evolved, and we are listening to practitioner impressions and problems. So, please give us some feedback.
Excellent. So for our last 11 minutes or so, I thought I would turn to some questions that have come in from the audience. Let's see, the first, let's go with, what is the current thinking about whether staking or other crypto-related returns should be reported as effectively connected income for non-US persons? Does anyone want to take a stab at that one?
Wow, so it raises a lot of issues. First, I think there's the issue about whether staking, the timing of inclusion for staking income, which is something that's near and dear to Abe's heart. There's a case pending on that. In fact, just today you published the motion from dismissal from the Justice Department. So there's a question about that, about when it's includable. Generally speaking, most practitioners sort of follow the notion, which is in the FAQs, that like mining, staking income is included upon receipt. So when you have Dominion control, when it's airdropped into your wallet, whatever, that essentially that is includable as income. The next question becomes source. So what is the source of staking income? And we don't really have good guidance on what sources and how that's to be determined. Source will determine whether it's FDAP, whether it's subject to withholding, whether it's ECI, and if it's ECI, how under 864 it should be treated, because there are different rules for foreign source versus US source. As you may know, staking is a validation process. It's done by nodes, and typically those nodes may be in servers outside the United States. They may be conducted by entities outside the United States, may be facilitated by Coinbase. We validate and engage in staking on behalf of our customers. So, but we do both within and without. We have an entire team that does that. We have an entire group that does that. So sourcing itself is not entirely clear. And I don't think you can really determine ECI unless you determine source. Once you determine source, and if you say it's US source, then you have to sort of evaluate how that fits into the 864 paradigm. And people have different views about that. So, and whether how staking should be treated. They have a different view about how crypto assets should be treated, whether it's a commodity for this purpose or whether it fits the securities and commodity safe harbor. So we just have a lot of interesting questions that come up with very few answers at this point. It's again, part of the overall question or issue would really challenge that we really just don't know. And so you have to what's the great, actually it's the fun part of this whole world that you're really starting almost, I point out to people, when you're starting conversations with Glenshaw Glass about what is income, then you know that you're at like the ground floor about something. And that's what makes this whole area very interesting. But so the answer is we really don't know. At least I don't think we know. Lisa, you may have a different view.
No, I actually think that was an excellent discussion of the issue. I really don't have anything to add to that. It was a great job, Larry.
I do like the idea that when we're starting from what is income, you know, we've really gone to the ground floor in terms of discussing the questions. So we've gotten a lot of questions in about NFTs. Are NFTs a form of cryptocurrency? Are they considered collectibles for purposes of the 28% maximum rate as opposed to 20%? Would anyone want to weigh in on that?
Well, I don't want to hog the, so I'll just say, to me, NFTs are really fascinating because everything we just talked about is based on their underlying premise, I think, that crypto is a financial asset. It's either, you know, it's like a security, it's a covered security for 6045, or it's a security for other purposes in the code, or it's a commodity for other purposes of the code. NFTs don't fit that paradigm. Lisa articulated the definition for crypto, including virtual currency, which I think an NFT clearly is not if you read the definition, or digital asset, which arguably it is. So I don't know that that's entirely clear because it's really a digital representation of value. Well, does that encompass an NFT? And NFTs come in a variety of different forms themselves. So there's no one, one construct for all of NFTs. So again, the short answer is we really don't know. They can be, in certain contexts, viewed as collectibles because they have the parameters to be treated that way, subject to capital gains treatment at 28%, as we know, in the US system. So they could fit that paradigm, but we honestly don't know.
Yeah, and I would just add to that NFTs, I mean, like sort of the early uses of NFTs kind of fell in that bucket of collectibles where they represent, digital art or some other form of media that could be viewed as art. But other use cases for NFTs are coming out. I mean, people are using them as, event tickets or concert tickets, and they include, special promotions and special experiences, being able to go backstage and meet the artist and things like that. And it's harder to say that those are going to be collectibles. And so I think you probably are going to have to look at the underlying use and what the NFT represents. But it is, I agree with Lawrence that it's hard to say that it's virtual currency, but the broader digital asset definition that Congress seems to be moving towards probably would encompass NFTs.
There's also an interesting question with NFTs. It's something that we worry a great deal about, and that's transaction taxes. This is really not IRS, but it's really states in what we call indirect taxes. And it actually pervades the entirety of the ecosystem as well. when do indirect taxes apply? But if it's property and you're selling property, and I won't even go into explore how that property is exchanged and the anonymous nature of that, who the people are and how you even collect this thing. But typically, a lot of states view digital goods as potentially subject to sales tax. Well, if it's a sales tax, how is that collected? Is it subject to it? And then if you're outside the United States, is it subject to VAT or GST? So we have, and that alone is a huge potential challenge and issue. As probably everyone knows, most countries actually collect more from transaction taxes than they do from income taxes.
And that's a fascinating issue. That in and of itself was probably worthy of an entire hour that we could discuss. So our most upvoted question, Abe, is really about your case, the Jarrett case. So you can comment on it to the extent that you can, and we understand if you don't want to comment on some of the procedural aspects. But the question was, with the Jarrett case and the underlying question of the timing of income recognition for virtual currency received through the proof of stake validation model, do any of the panelists have opinions on what the answer should be?
Well, that one I can speak to, leaving aside the case. The issue itself, which I wish were getting a little more attention, generally has to do with the nature of this property coming into that is acquired. And speaking of Glenshaw Glass, this is what brings us to very deep principles with all this discussion of potential guidance and so on. This is a very special type of question. The question is whether certain types of property acquired in a certain way is or is not income under the tax code. And I mention that because we do want guidance, but it must be correct guidance, because the IRS does not determine the answer to this question. The tax code does, backed by the 16th Amendment to the Constitution. And it's a question of law and what is or is not income. And the position that I've laid out in my writings for tax notes, and it's being played out now, is that new property not received from another person as payment or compensation is not income. And certainly I do have a strong opinion on that, and also as to the importance of that for the evolution of this ecosystem, because the legal answer here is, property that I create is not yet income. The other way to look at that, which I think is very helpful, is that when property is income, it's because it comes from somebody else. It comes from another person, and that's one way to check. Is this apple income? Well, it might be if I received it as compensation from another person. But if I grew it myself and didn't receive it from another person, it is not until I sell it. But the practical implications are important. They don't speak too much to the legal answer, but in the background on all of this is the administrative costs and challenges for accounting for and also dealing with the overtaxation, which is another important consideration here, of having a tremendous number of taxable events throughout the year. And that's a problem that goes away with regard to new property when it is properly viewed as not coming from a source.
So Abe, would that same reasoning then also apply to mining rewards, which, at least the IRS has taken a position on in published guidance? Mined
gold, mined oil are not income until sold. And I'm waiting for an explanation for why a mined Bitcoin could possibly be any different.
That's fascinating.
So there you have it. It's a service. It could be viewed as a service, it could be viewed as a royalty, or it could be viewed as created property, the way Abe described it. So I think we just have a difference of opinion and no real clear answer.
I think that seems like some of the general theme is that there's a lot of opinions out there. There's a lot of questions. There's a lot of open questions that all need answers. In the last minute, Carolyn, I want to turn it back over to you for our last minute of time. If there's anything else that you want to get out to our audience today, I do think that taxpayers are wanting for information and are trying to comply and are trying to do the right thing. And is there anything else that you feel is important for taxpayers and their practitioners as we're coming up on filing season?
Sure, thank you. And first of all, we hear you. We know these issues are out there. We know that they're percolating. We're working on it. We're working very hard on it to try to strike the right balance and provide clear guidance in a timely fashion. We hear you. Is the first thing I want to say, not only to the audience, but also to the panelists, who are really some leaders in the community. Also, just getting back to the filing season, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in virtual currency? Again, you have to check the box, yes or no. There's instructions to the 1040 that are very clear. If you check the box no, if you did not engage in any virtual currency, if you just held it in the wallet for a year, if you transferred it between wallets you own or control, or if you just bought it. And then there's also some clear delineations on when you do check the boxes yes. So, please encourage your clients and your colleagues and yourselves to make sure that you are checking the box and you are coming into compliance. So I think that's it from me. Mike, did you have anything else from IRS's perspective?
One quick thing, as noted in the fiscal year 2021 Putting Taxpayers First publication, the IRS is continuing to implement its virtual currency strategy. And I mentioned that because it's a comprehensive collaborative strategy, including all of the business operating divisions. So we're hearing diverse voices on the issue. And we're, taking taxpayers' considerations and concerns and public's concerns in account all along the way.
Wonderful, thank you. And thank you to the entire panel today. This was a very interesting discussion and one that I know that we'll be having again because there are a lot of open issues. So I hope that everyone else enjoyed it as much as I did. And I thank you very much and everyone have a great rest of your day.
You're welcome, thank you.
Thank you very much.